If I had one thing I could suggest in anyone's succession plan, it would be to seek advice at the beginning before you start making decisions. And the reason why I suggest you seek out a advisor before you make decisions is because it could put you in a position of either paying more tax, putting yourself into more risk than you wanted, or it could mean that you don't get the outcome you wanted for your succession plan. Hi, I'm Juston Jirwander from Bishop Collins Chartered Accountants. Succession planning is, I would explain it as the passing on of your legacy. That's probably the most important part. That legacy could be in continuing the business or the activity in your name, or its intended purpose, its higher purpose, or it could just simply be money. You want to make sure that you maximise the amount of funds that you get for that for your retirement planning. So that's succession planning. Succession planning is really important for really anybody that has a company, for high net worth individuals, for anybody who wants to see their business or their activities continued on. It's something that you need to think of at least 3 to 5 years in advance. The reason why you need to think in advance for succession planning is there's lots of things that need to be done to prepare the business for that transition, to reduce taxes, to manage risk, and to make sure you get the highest price or the best outcome for your succession planning. So to give you an example of the people who might be looking for succession planning and what they're doing, one could be retirement, as simple as retirement. Succession planning could also involve just the sale of a business and moving on to another business. Succession planning could involve passing it on as a legacy to your children, and that's sort of integrated into a bigger picture around the will and what you intend to do with that. Succession planning could actually be part of growth, as part of a growth strategy. It could be high net worth individuals who want to create a family office and they want to create something lasting more than what their activities are now. So they might want to create a foundation. And part of that succession planning would be, how do I transition my active business to support this foundation for the years to come? A really important part of succession planning is knowing what the value of your business is. What you need to do is plan ahead. The reason why we say plan ahead is because then you can maximize the value. Obviously, everybody wants the most value they can for the business that they've worked for possibly 20, 30 years to create. So trying to understand the market value is the most important thing. The market value is determined as a willing buyer and a willing seller meeting to create a figure that they're happy with. Now, the tax office doesn't necessarily look at it like that, but they do accept that principle. They will want to know that it's been valued by a proper valuer, so that there's no collusion between the parties. So trying to get the market value is critical, and ultimately we can get a value and then we have to let the market decide ultimately. It's a balance, and it's a bit of I'd say it's a bit of a game. Let's say more of a strategy than a game. But it's a strategy on how to maximize that value, because you want the most of it, and also it's needed to determine your tax levels. So obviously if you get a higher value, you're happy to pay more tax, or you will have to pay tax. But timing again comes in, so we can ensure that if there are some concessions, that tax is minimized. And that's where you really need to see somebody before you decide to do anything. Don't do it and then come to your trusted chartered accountant advisor like Bishop Collins and say, I've just sold my business. That's not an advisable thing. We would like you to speak to us beforehand. So when you value a business, there are multiple ways to value it. There's a net asset value. So that's just looking simply at your balance sheet, get your assets, your tangible assets, take away your liabilities, and you've got your net tangible assets. And that's one way. I would say that's a very, very crass and very low way to get a high value. Another way is to look at the earnings of the business, the future maintainable earnings of the business. What do you think the earnings will be ongoing? And applying a multiple. Now, the multiple is determined by risk. The higher the risk, the lower the multiple. The lower the risk, the higher the multiple. So they're inversely related. What that basically means is if it's a really risky business, then the amount of earnings I get, I'm not going to want to pay more than 1 or 2 times that earnings. If it's a really safe, steady income stream, I'm going to get it all the time, then I'm willing to risk it a bit more. And so I'm willing to get, 3, 4, 5 times that. So that's where you get the multiple. Multiples in public companies are much higher because they're much lower risk and more stability, and there's more liquidity. So you've also got liquidity involved in there. So I've talked about planning and timing. It's really critical, and the reason why it's so important is planning to not only prepare to get the highest value you can for your business, or to get all the parties in line for your succession planning, because it may not be just selling a business. But timing from a tax point of view is critical, because we want to make sure that you're not creating a taxable event all at once, and that taxable event could be timed in a better way. It could be staggered over multiple years. It could be staggered between different parties. So planning is essential, and timing is a large part of that. But the other part of planning is to get the right entities involved, to get the right scenario involved, to get the right deal across. And that's where it's critical you get some advice. So as you can see, planning involves timing as well as strategy, as well as making sure you have all the right entities involved in the succession plan. There are some pretty generous tax concessions which are available to small businesses particularly. To be a small business, there are certain conditions that have to be met in terms of revenue of the business, or assets held by the parties. Now, some of those benefits, for example, can eliminate the capital gain. For instance, if you've held a business for 15 years or more, you are a small business as defined by the relevant tax legislation. Then and it's an active asset, there are a number of conditions which I can't go through in a short instance. It needs to be reviewed, and every individual is different. Then not only from capital gains tax point of view do you get a 50% general discount from the gain. So if you sold your business for $1 million and it had a cost base of say $500,000, you've got a $500,000 gain. Half of that as a general discount can be reduced to $250,000. Again, you can get the active asset if you satisfy conditions, so that can reduce it from $250,000 to $125,000. And then if you have other small business CGT, if you qualify for the 15-year small business CGT concession, there'll be no capital gains tax. You can see that that's very attractive. There are other elements of that you can do, the retirement exemption. There's also the ability to put money into superannuation, in this instance to offset any capital gain. So if it was $125,000, you put that into superannuation, at least you'll have no capital gains tax. The money will go into your super fund and it will be taxed at 15%, but you've got it at a lower tax environment. Larger organisations, high net worth individuals will have less of those CGT concessions, which is why it's even more important to look at some of the other strategies around timing, structure, and the entities that are involved. Succession planning poses quite a few different challenges. Those challenges are obviously taxation, maximising your return. They're the main ones that I suppose are common to pretty much everybody, and risk. But some of the more intricate, or let's say challenging ones, I would say come from the heart. And those ones are how to deal with something that you've built up and created, and how do you pass that on to the right people so that it'll continue its purpose. So there's often a lot of feelings around employees, around clients, and around self-worth. What are you going to do next? Is my legacy going to continue? I think an important aspect of succession planning may be when somebody is forced to change their situation because of health concerns. I just want to touch on it briefly, but it is important because the timing aspect of this in terms of the succession plan is different. There's more of an immediacy. Now, when you tend to be immediately needing to resolve something, it can lead to maybe not achieving the highest return that you could, or the best outcome. So it's really important to get your strategy right and try and understand what timing is, what timing is required, what needs there are, what the desired outcome is, and then we can work with those people, because there's just too many elements there. But it's important that if that is the case, seek an advisor and meet with them, because it's too complex to go through in a short explanation. There are many moving parts. I'd like to give you an example of a broker that I assisted in a deal that was, in my opinion, probably one of the best deals for both parties. There was an urgency from the seller from certain health issues, and there was the buyer who had a very good business to take on if they could get through these points. And the deal kept being stalled by sometimes advisors, but mostly by the ego of each party. And I have to say that ego gets in the way sometimes in terms of selling and finding out the real market value. But even when you get to a good market value, when you start getting into the nitty-gritty and there's little fine adjustments to do with annual leave provisions for staff or valuation of stock or valuation of plant and equipment, it's really important to remove the emotion out of it and to understand from your advisors what the benefit is. This was probably one of the best deals, and if I had some cash at that time and the right position, I would have loved to have bought it. But unfortunately, the deal didn't go through, and with this particular transaction, because they wouldn't agree and they felt like each party were giving too much. So the succession plan of the person who had to sell due to health conditions didn't get to sell, and the buyer, who had a very good deal that could have fitted straight into his current organisation, didn't reap the benefits. There's a happy and a sad ending. The happy ending was that at a later date, the seller was able to find another buyer at a higher rate, and the buyer who lost out came to me later and said, I wish I'd listened to your advice and didn't get my emotion involved. I really missed an opportunity. So another reason to listen to your advisor and try to remove the emotion.